For years, income investors have faced this dilemma, haven't they? You chase higher yields, maybe take on more risk.
Or you stick with the old ways, the traditional income streams, and they often just feel a bit stagnant.
Exactly. But what if there was a genuinely new approach? Something leveraging strategies that were, frankly, out of reach for most people until now.
That's the question on the table today.
All right, let's really dig into this. Because Canada's financial landscape, well, it just saw a pretty significant launch, a new suite of ETFs, the DayMAX ETFs from Hamilton Capital Partners.
And the buzz is all around how they're using this innovative strategy, 0 days to expiration options, or 0 DTE, a first for Canada, they're saying.
Right, touted as the first ever. So our mission for this deep dive is clear. We need to understand what makes these ETFs tick, what makes them unique.
And why the industry is calling them an exciting milestone.
Crucially, yes. And what the implications might be for your portfolio and maybe even, where the whole ETF market is heading. So the catalyst for all this buzz, it happened very recently, July 15th, 2025. Cboe Canada Inc. welcomed Hamilton ETFs as its latest issuer.
And that was the day they launched the DayMax suite. Now trading on Cboe Canada, QDA, SDA, and CDA are the symbols.
But here's where it gets really interesting, like you said. Positioned as the first ever Canadian ETFs to utilize 0 days to expiration, 0 DTE, options to provide income.
It definitely sounds groundbreaking.
It does, but you hear short-term options, you think volatility. Does first ever here also mean maybe a higher level of complexity? A different risk profile investors really need to wrap their heads around, even in an actively managed fund?
That's precisely the question we need to unpack, yeah. What's fascinating, I think, is the core innovation here. It's integrating these 0 DTE options into an ETF wrapper.
Meaning packaging these complex short-term strategies.
Exactly. Packaging them into a single fund you can just buy easily. It makes them accessible to way more people. Now, 0 DTE options themselves, they've been around a while, right?
Right. Sophisticated traders use them.
But putting them inside an actively managed ETF structure, specifically built for income generation, that's the significant development here, especially as a Canadian first.
So these 0 DTE options, just remind us, they're super short-term.
Incredibly short-term. But what's really innovative is how that extreme brevity is being used daily within the ETF.
Daily?
Yes, daily. The fund is constantly, every single day, selling call options that expire that same day. They collect the premium, and that's the direct source of the income.
Wow, okay.
This constant daily cycle, it offers a vastly different risk-return profile compared to, say, traditional monthly option strategies.
Yeah.
And it means the fund is constantly exposed to very immediate market movements.
Understood. So knowing that's the engine driving these, let's look at the products themselves. It wasn't just one fund, it's a whole suite.
That's right.
Can you walk us through the specifics? QDA, SDA, CDA, how do they differ?
Absolutely. Hamilton launched 3 distinct funds, but they all share that core objective, income via 0 DTE options, plus a bit of leverage. So first, you've got the Hamilton Enhanced Technology DayMax ETF, that's QDAY. Focus is mainly U.S. tech stocks. Uses that active, ultra-short-term option strategy, and it has modest 25% leverage to, boost that daily premium income.
Got it. U.S. tech plus leverage?
Then there's the Hamilton Enhanced U.S. Equity DayMax ETF, SDA. This one gives you broader U.S. equity exposure, again using the same active option strategy, and that 25% leverage to supplement the returns.
Broader U.S. market, same mechanics.
And finally, the Hamilton Enhanced Canadian Equity DayMax ETF, CDA IFI. This one targets income primarily through Canadian equities, though not exclusively. And again, employs that actively managed, ultra-short-term option strategy on its North American equity exposure.
So Canadian focus for CDA.
Right. And across all 3, Hamilton's stated objective is pretty clear. They're purpose-built for income-focused investors. The goal is higher and more frequent income.
By writing those daily calls and using the leverage?
Exactly. While still giving you exposure to the underlying equity market U.S. tech, U.S. broad, or Canadian, they aim to deliver attractive premium income, broad equity exposure, and the potential to benefit from overnight market gains.
Okay, so that potential to benefit overnight is interesting too.
It is, but it raises that key question, right? How does this new structure really resonate with what investors need today? And what are the specific things people need to think about beyond just higher and more frequent income?
That's precisely what I was wondering. For someone focused on income, is this just More income, plain and simple? Or does it represent a fundamental shift in how they might need to think about their portfolio strategy?
Oh, it's definitely more than just more income. I mean, think about it. For a traditional income investor, yes, these funds could offer higher cash flow than many dividend strategies. But it's coming from a totally different place, right? Daily option premiums, not company profits distributed as dividends. That's a key difference.
And the nuance there.
The nuance is that while they're aiming to capture that premium income daily, they are still exposed to the ups and downs of the underlying stock market. And that 25% leverage
Amplifies things.
it amplifies both ways.
Yeah.
It boosts the potential income from the options, yes, but it also magnifies your exposure to market swings by that 25%. You really have to understand that interplay.
So the risk reward is quite different from, say, a regular covered call ETF or a dividend fund.
Significantly different, yeah.
Yeah.
Investors need to grasp the daily cyclical nature of the income generation and that heightened market sensitivity. It requires a different kind of understanding.
Okay, so given those mechanics, those characteristics, what's the industry saying? We heard Jennifer Mercereau, co-CEO at Hamilton ETFs, was excited, citing SIBO's innovation focus.
Yes, she highlighted that partnership.
But looking bigger picture, what does this signal for the Canadian ETF market as a whole? Is this a one-off or something more?
Well, if we connect this to the broader view, Victor Werney, over at SIBO Global Markets, he's head of North American ETP listings, he commented that this rollout marks an exciting milestone for the Canadian ETF industry.
An exciting milestone. That's strong language.
It is, and he added that SIBO, being a leader in the global derivative space, is thrilled to be part of these unique product launches that feature zero DTE option strategies.
Okay, so let's unpack why it's a milestone. What makes it so significant for the ETF market, especially here in Canada?
Right. It's significant because it's a pioneering product type in a major market. It signals a new frontier, really, for how ETFs can be built to deliver specific outcomes, in this case, income, using quite advanced derivative strategies.
Strategies that weren't easily accessible before.
Not really. For years, these kinds of rapid-fire daily option strategies were mostly used by institutional traders, maybe some very active retail folks with specific options accounts. Now,
They're packaged up, democratized.
exactly, democratized into an accessible fund format you can buy like a stock. And the fact that this innovation is coming from a fast-growing Canadian player like Hamilton ETFs, they manage over $8 billion now, one of the fastest growers that matters too.
How so? What's the potential ripple effect?
Well, it could definitely spur more product development, inspire competition within the Canadian market. We might see a wave of new, perhaps even more complex, derivative-based income products trying to capture attention.
So more innovation, but maybe more complexity for investors to navigate.
That's the trade-off, isn't it? It likely leads to a more diverse ETF landscape, which is good, but also potentially a more intricate one. It brings opportunity, sure, but also requires increased scrutiny, both from regulators and investors. It definitely impacts the direction of the market.
It really feels like we're watching a new chapter unfold for ETFs, where these sophisticated tools get packaged for a wider audience.
It's fascinating to watch these trends evolve in real time.
Absolutely. And just on a practical note for you, the listener, it's worth remembering you can access these new Hamilton ETFs through your usual investment channels. Discount brokers, full-service dealers, they should all have them available.
Standard access, yeah.
So to quickly recap then, the DayMAX ETFs, Canada's first using zero DTE options specifically for income. They offer leveraged exposure to Canadian, U.S., and U.S. tech markets. A very distinct approach.
And this launch really underscores that ongoing evolution in the ETF world, doesn't it? Increasingly sophisticated strategies, things once confined to the pros or complex DIY setups, are now being wrapped up in these more accessible fund formats.
It's a response to demand.
I think so, yeah. It's proof that ETF providers and exchanges are actively listening to investor demands for innovative ways to generate income, and they're pushing the boundaries of what you can get in a single ticker.
Which leads us to the final thought for you to consider. What does the arrival of these first-ever DTE ETFs really tell you about where packaged investment products might be heading next? And how might innovations like this, with their unique risk-reward profiles, influence how you think about generating income from your own portfolio?